You can see it now. All right. Well, good afternoon, everybody, and thank you so much for making time to join us. My name is Mary Grove, and I'm a general partner here at Bread and Butter Ventures, and I'm joined by two of my teammates today, Stephanie Rich, who's our head of platform, and Anna Wilgos, who just joined us last week. She is our executive assistant here at Bread and Butter, and we're so thankful that you could take an hour to spend with us today. I would really love to make this session as transparent and open as possible, so really would welcome we're going to have time dedicated at the end for questions. But as you have questions throughout, please feel free to go ahead and just drop them into the chat here, and Steph's going to help us kind of bash them and make sure we can get to as many as possible. And so just to set the stage here, let's see. Okay. Just to kind of set the stage here on the context for this series that we're launching today officially. So Bread and Butter Ventures, we're really excited to launch our Female Founders series, which is really an effort to help think about how you can democratize access to venture capital across the industry and just provide more free and we hope helpful content to female founders specifically who are building venture-backed startups, in particular at the early stage, which is where we invest at Bread and Butter. So that's the overall goal. So once a quarter, a member of our team is going to host a deep dive content session like the one that we're doing today. And then attendees will get access afterwards to one-on-one office hours sessions with various members of our team if you're interested in that. So really, this is our way of, we hope, opening up a little bit more of the closed network that is venture capital sometimes today. So thank you all so much for being here and excited to get started. So just a little bit about me, just to quickly introduce myself. So as I shared, I'm one of our 4-person team based here in Minneapolis, and there's so many things that have led me to where I am today, and I'm incredibly just so grateful to do the work that we do at Bread and Butter and to be able to back and support and work with just outstanding entrepreneurs from all over the country and all over the world, in fact. But my story in a quick nutshell, starting at the bottom right, I come from a very scrappy immigrant entrepreneur family. My parents were both immigrants from Thailand who grew up in rural villages without electricity, and really just their distance traveled and their entrepreneurship to me has personified the American dream. But my parents moved here separately to the US, met, got married, raised 3 children. They both had backgrounds in healthcare, and I watched them build businesses together for over 35 years. And so that upbringing, that foundation in entrepreneurship and the grit, the tenacity, what success looked like and what failure looked like as well, was just such a privilege for me to grow up in that environment. So moving on to other parts of my life. So on the top left, that's chapter 1 of my career I spent at Google. So I spent 15 years at Google. I thought it was 1 year on the way to law school, but had a very fortunate set of experiences there. Worked on the IPO deal team when the company went public in 2004. Then I spent 6 years doing early stage product partnerships and business development. And that really helped inform a lot of operational work that I do with our teams today in terms of thinking about business development and go to market. But that team that you see there was my last team at Google, which is today called Google for Startups, really thinking about some of the early investing infrastructure for the company and how we invest in both founders, directly looking at funds, and then ultimately looking at how do you help invest in startup ecosystems. The photo on the top right are some of the youth from a nonprofit that my husband, Steve, and I started 10 years ago called Silicon North Stars to help youth from economically underserved backgrounds, specifically from Minnesota, access futures in tech. And so we've been running that program. This is our 10th anniversary this year. We have 175 youth who have gone through and we're just so proud of that work. And then the bottom left is my family. So my husband, Steve, is a Minnesota native. I'm a proud Minnesotan by marriage. So I moved here in 2018. Those are my 7-year-old twins, Luke and Lottie. And it's just a little bit about what kind of drives me and what inspires me, in addition to really getting to do the inspirational work every day of backing founders who are building the next generation of amazing companies. So I just gave you a little bit of that, but in terms of my experiences prior to partnering with the team here to help build Bread and Butter in 2020, I was an investment partner at Steve Case's team. Steve is the founder of AOL, his firm Revolution, on the Rise the Rest seed fund. So I really have spent my career to date in tech and early stage investing, and that's kind of the lens that I'm bringing to you today. So, Bread and Butter Ventures, who are we? And I will give this caveat that I'm so glad that you joined us today, and we would love to find a way to be helpful and support your journey, whether or not Bread and Butter is a direct fit for investments. So I'll just give that caveat. We are here to help. The goal of the series is to help. We do have a quite specialized focus at Bread and Butter. So we're based here in Minneapolis, Minnesota. We invest all across the country. We can invest internationally, but we primarily do focus on US-based companies and US markets. And so we're seed stage investors investing in these core sectors. We think of them as the bread and butter sectors of the modern economy, if you will. And so a super deep focus on the food system, on healthcare, and on enterprise SaaS. And we'll talk a little bit about each of those, but essentially, we're so excited about our location here in Minnesota. Minnesota is home to the highest concentration of Fortune 500 companies per capita in the nation. And we leverage partnerships with industry to really support companies in outsized ways after we invest. So you may have heard of a lot of the companies in our backyard, from General Mills, Cargill, Ecolab, Schwann Suit Company, 3M, Target, Mayo Clinic, Blue Cross Blue Shield, US Bank, Securian. A lot of these companies are partners of ours via what we call the Bread and Butter Innovation Circle. So that's our focus. Food tech for us is all about the tech stack. So software, tech-enabled hardware. Think about everything from robotics, on-farm, supply chain, manufacturing, distribution, future food retail and delivery. So we are not investing at this time in CPG, consumer packaged good food products. We're really focusing on that tech stack of the industry. Healthcare, our mission there is to invest in technology that democratizes access to quality care for all. And that's really focused on software and tech-enabled hardware, tech-enabled care delivery. And so not medical devices, not pharmaceuticals, just specific to our fund's thesis. And then thirdly, enterprise SaaS, that's B2B software pretty broadly, but we do tend to find ourselves especially drawn to future of work and future of supply chain as two of the critical areas for us. And so a little bit about us. So to date, we have 75 companies in our portfolio now. We are actively investing today. We tend to invest in seed rounds, and seed to us, typically these are rounds that are $1.5 to $3 million total round size. And our average first check is in the $500,000 to $1 million range. And these are companies that typically have raised some small amount of pre-seed or angel funding to date. This is their first institutional round, just in terms of where we love to invest with our core focus areas. And then we get the question a lot, do you only invest in Minnesota? The answer is no. We have a pretty large footprint across the US, but we do want to be the front door to our region and our state. And so you'll see some of the numbers reflected here. And then across the first three funds, we are really big believers that the way to drive financial return, really the best way to do that, is to cast the widest aperture possible and see the best possible deal flow. So we want to see founders from all backgrounds and all types, and we're glad to be doing this series with you today. I'm just going to flag for you stuff that I can't see. So if there's anything you want to flag for me, do it. I can just see my slides. So okay, so I'm going to just do a deep dive now into several different areas from an agenda perspective. Actually, here's the agenda we're going to go through. So we're going to talk through a little bit. I'll share some macro trends that we've been seeing across the industry, and then we'll go quickly through this entire set of kind of really action-oriented tips, if you will. And then I'd love to leave time at the end for your questions. The art. It's an art and a science, I would say. But I want to first give you just a quick macro view of the market. It's been a very challenging last 18 to 24 months. We've seen, the market really began to slow down early 2022. What we saw was really the lack of the pressure in the public markets, so less companies going public, with less IPOs, less later stage M&A. You started to see that trickle down further and further and further, and it's squarely hit us now at seed stage. And so some of the insights that we've learned, capital continues to be expensive, right? We are seeing, just to give you a sense, at Bread and Butter, we have been seeing about 2x the volume of deal flow that we usually see. So this is anywhere between 2,000 to 2,500 deals a year coming in, kind of top of funnel, we call top of funnel, and those are very high quality deals. It is an investor friendly market right now for sure. So we are seeing valuations have come down somewhere in the 20 to 25% range from where they were in 2020 and 2021. So we're seeing that as a trend. The second is a lot of early stage venture funds, micro funds. Micro funds refers to funds that are sub $100 million funds. A lot of them are out in market right now raising, and we've been spending time with institutional limited partners who invest in venture funds to get their take. And really, it's been a very, very tough market. One data point I can share with you, in 2021, there were 2,400 micro funds, so sub $100 million funds in the US, 2,400 in 2021. In the beginning of 2024, this year, that number was 1,200. So you're seeing a lot of pressure towards the funders too, in terms of the early stage funds. And we're just seeing that the market is really favoring funds that have a more specialized focus versus a totally generalized focus. Rounds are taking longer, right? Where we used to plan for 4 months to execute a fundraise, that's likely 6 months plus now. So this is, not the best news, but the good news is there is capital out there, and I'm going to walk you through some of our thoughts on how to make the most of a challenging fundraising environment. Okay, so I will give the big caveat at the beginning that, of course, there are exceptions to every rule. These are some of the learnings and the trends that we're seeing across the bread and butter portfolio and our universe of co-investors and partners. But of course, there are exceptions in all cases. So I want to start with the first existential question for any business. And there's no one right or wrong path, right? So when is venture capital the right path, the right way to capitalize a business? The 3 questions I think about are, what are my long-term goals for the business? So that's to say, venture capital is one very specific type of funding with a very specific business model behind it. And so are those aligned? So if your goal, for example, is to build a meaningful, profitable business that is having a big impact on the world, and then you want to pass that on to the next generation, your family, likely not the model for VC. VC is a very specific model where the investor at the seed stage is hoping for an exit in that 7 to 10 year time frame, with a growth trajectory that is at least 3x year over year growth. The reason to raise capital is very specific, right? Which is here. Why would you fundraise? Why take venture capital? And this is another great question, because if you can build a business that grows as you would like it to and still own 100% of your company, 100% of equity, that's absolutely a viable path. And so the reason to fundraise is to create more value, to grow the size of that pie more quickly in a way that requires more capital to do so. So in the example here, right, where a company's value is $1 million, the founders own 90% of the business. The other 10% is, through an employee stock option plan, and that's the 100% of the pie today, worth $1 million. The reason to raise venture capital might be we want to hit that 3x year over year growth and really accelerate. And so we've raised capital. We've sold 20% of the company in the seed round. And now we see that the total value of the company is $5 million, right? But the founders only own 70%, the investors own 20%, and then the employees own 10%. So this is a little bit just a simplified example of why it makes sense, why it can be compelling if that is indeed the right path for your business. Okay, so how to think about round size and valuation. We invest at Bread and Butter across the variety of these vehicles. So safe notes are becoming extremely popular, right? The Y Combinator kind of set the standard for the safe. We invest a lot at safe. Safes are great for very early on when you don't have yet enough business under belt to really maybe know the valuation. You want to raise a quick $1 million, $500K, 1.5 million. That's great. Convertible debt note acts similarly to that, but it is actually debt that you're taking on that you will need to repay. So safe can be a much more straightforward mechanism. It used to be that not all investors invested in safes, and I think that's continuing to change towards yes. And then, of course, the priced equity round. We love price rounds. We primarily invest in price rounds, although we look across the gamut here. And the reason price rounds are nice, if you're raising a larger round, like a $3 million seed round, ownership is very clear. If you have previous safes or debt notes on your cap table, those convert over and keep your cap table really clean. So when you think about how much to raise, right? So what is the use of proceeds, so to speak? We recommend targeting 2 years, so target 24 months, minimum 18 months, especially in this funding market. It is very difficult to go out and raise again in a year or under a year. And so we recommend thinking about raise enough to try to help really clear the hurdle of where you want to be when you raise the next round. And we get a lot of questions about valuation, right? At the seed stage, valuation truly at this stage is largely based on dilution, right? That's because companies are early, maybe you're pre-revenue, maybe you're generating, 250K in annual revenue. We don't yet have enough under belt to really value a business as a multiple of revenue, or at least it wouldn't be a multiple that you might like to see. So really think about it as calculation based on dilution. And so typically at the seed round, we expect that a company would give up somewhere between 20 and 30% dilution, with 25% being right up the middle. So for example, if you're raising a $2 million seed round at an $8 million post-money valuation, that's 25% dilution, right? That's like pretty classic. And then there are companies that can raise with less dilution or more dilution, depending on other factors, but that's largely one way to think about it. And I want to give you a really important tip here, which is that it's super important to us at Bread and Butter. We want founders to own the majority of their business after the seed round, because if you're building a venture-backed company, you're going to raise multiple rounds of capital before you ultimately exit. And we want founders to be incentivized to go the distance by owning sufficient equity. So when we look at rounds where, okay, after this round, the founders are only going to own, it can get challenging, right? So you want to target that 50 to 75% ownership. And if you're not going to hit that, talk to your lead investor before you commit about doing a refresh to top up the founders and see if they can hit that minimum threshold. So that's a really important piece at the seed stage. Okay, so we're going to raise a round. So let's pretend we're going to raise a $2 million seed round. So it's really important my biggest piece of advice is to prep and execute an extremely tight, managed process that will make this process so much easier, rather than I'm going to start having some conversations, test the waters, and kind of just have a drip campaign, so to speak. So a few things here, right? Number one, do your research on investors that fit from a stage perspective, from a values alignment, from a sector. Easily research their portfolio, see what they've invested in, see if there's any competitive conflicts that you would be worried about there, and utilize a tool. We use Google Sheets. We run on the Google Suite here at Bread and Butter. And so when we work with founders, we will prep with them. They take the lead on creating that first pass list that's prioritized tier 1, tier 2, tier 3, based on a variety of factors, and share that out, right, with your investors beforehand, your current investors, and start to line up, who are my initial targets? Do I have a warm introduction there? Do I know somebody who knows somebody there? Or do I have their info to do cold outreach, right? So you're starting to really prep that pipeline process. And you'd be surprised, at Bread and Butter, we get so much inbound that is really not at all a fit for us, like a Series D company in aerospace based outside the US, right? Where research will save you a ton of time on the front end. That's one. And we're going to talk about kind of prepping the materials as well and what should go into that. So really prepping everything before you go out for the raise. So of course the pitch deck, and we'll get into the pitch deck in more detail, but the most important things: pitch deck, your financial model, and a really important is an intro blurb, which is the quick half-page summary of your company. And we can share some examples after, but that just give a very quick, that I could scan in the period of 30 to 45 seconds and really understand succinctly what this company does, what their traction is, and what they're looking for in an introduction to the firm, right? So pro tip, organize your data room before you launch too, so you have everything ready to go. I recently had a great conversation with a company, and it was an interesting first meeting. Their round was moving really quickly. And then I said, great, would love data room access. And they didn't share with me for over 3 weeks, which kind of the momentum, so really be ready to say, great, had a great meeting. It's in your inbox tonight or the next morning. So I'd say for the time-bound process here. So we've got everything prepped, right? And just to go through again, just I'm going to go back one second, just what's in a financial model. A financial model is a projection of the business. So you have historical data to date, and then you have the model, which looks ahead. And we want to see in a model at least 3 years out. So from right now, if looking at companies, we want to understand where will you end 2024? What does 25, 26, and 27 look like? And what are your assumptions in that? And as seed stage investors, we know the financial model will almost certainly change in the real world, but this is so important to demonstrate and just to show how a founder is thinking about their business, thinking about their growth trajectory, thinking about the levers, and ultimately, what's their ambition? And this can go both ways, right? This is where we recommend we want to see 3x year over year growth or more that is feasible in your mind over the next 3 to 4 years. And also can't be absurd, right? We had a case where we had a company who was doing 200K in annual revenue, saying they were going to hit 900 million in 3 years. And there just really wasn't a mathematical path to that. So keep in mind, right? We want ambitious, shoot the lights out, but also realistic assumptions to support where you're going to go. Okay, so we're ready to prep. We're ready to go out now. So I recommend, you launch in a phased approach. So tier one, and that's tier one by your definition, right? Tier one investors on your dream wish list. So we go out first with, let's say, 30 introductions batched across at the same day. Let's say it's a Monday, we're sending out 30 introductions. We try to line up as many first meetings as possible. We see how that goes for 7 to 10 days, and then we hit wave 2. The next 30 intros go out. So again, you're running this like an enterprise SaaS sales process. And it's really important that we think of it as a funnel. Use a CRM, whatever CRM works for you, to really track and try to move people along. So that's my first piece of advice. Second is to really communicate and follow up. And that sounds very obvious, I'm sure, but you would be surprised at how much exceptional communication truly sets founders apart. In the top echelon, the top 10% of founders that I've worked with are following up. And so we'll talk a little bit about some of the tips and tricks around that. But I would say most importantly, understand that unfortunately, time spent fundraising is a distraction on the business, and it is going to require a significant portion of your time as a founder, as a CEO. And so just know that, communicate with your team, and really dedicate the focused time so you can try to move through it as efficiently as possible. And it's honestly, it can be quite fun and joyful too, right? To share your vision, your mission, to get really tight on your narrative, but know that I'm not going to be able to spend the amount of time I spend on sales today or whatever it is that I'm overseeing internally because I have to dedicate the time. And I've seen situations where founders don't dedicate those cycles, and it really stretches out, having a much longer impact on the business for a longer amount of time. Okay, so I wrote a blog post about this and we'll share, links to a lot of the content that we've produced, but I really feel there are just a few small things that you can do as a founder to really set yourself apart for a terrific first meeting. So this is specifically the first meeting, right? So 4 quick things. Number 1, landing the meeting. And we talked about this a little bit in the previous slide, but it's a quick personalized introduction, right? That shows the company. And I don't want to spend time trying to figure out what the company does. It's best for you to say in your own words, we are a Nest Collaborative as a maternal health platform focusing on lactation support. Great. Like it's a very succinct 1 to 2 sentence summary that tells me what the purpose is. But if you can personalize that introduction, land a meeting with an investor. So for me, it might be, hi, Mary, I see that one of Bread and Butter's core focus areas is healthcare, and I see that you've invested extensively in women's health. Maybe mention a couple companies. We are building XYZ in this space, and think that this aligns with your interests and why you'd be value add to our company. Here's what we do. Here's a few bullets of traction. Can we connect? And that's a great way to land a meeting, right? It's personalized. It shows thoughtfulness. It shows actual alignment. So great. So we get the first meeting. Pro tip is step 2. So before the meeting, what to do before the meeting? Make sure that no matter when, if the meeting was set, let's say 2-3 weeks, sometimes a month ago, right? These sometimes are pushed way out. My biggest advice is 48 hours before the meeting, so 2 days before the meeting, bump that thread and say, I'm really looking forward to meeting you, reattaching our overview deck here. And here's a couple bullets, highlights to share with you since we last connected. Right. So it's here, it's top of mind. You're teeing it up for somebody. I do this myself, I'm a fund manager too, right? We raise our funds for bread and butter. It's super important to do that a day, at least one day before, ideally 2 days before. So you're top of mind, and they're not spending the first 10 minutes of the meeting digging through their email, trying to remember what it is the company does. So that's one important tip. Some founders have feelings about not sharing decks before meetings. I'll just give you my very transparent take. I don't like that. I like to be prepared and do my homework and respect your time. Most first meetings are 30 minutes, sometimes 25 minutes. And so if you've already agreed to a meeting, absolutely send the deck and send a version of the deck that you're comfortable, sharing in that meeting, obviously. But the more that I feel like I can be prepared, the better that use of time will be, rather than spending the first 15 minutes of a precious 30-minute meeting trying to kind of suss out again what the business is. And then step 3, again, keeping in mind that these are typically only 30-minute meetings, time management is super important. So you definitely want to establish that a personal rapport and the pleasantries at the start of any conversation for sure, but just be cognizant of, okay, we have 30 minutes. I encourage you to take control of driving the meeting, not in an unnatural way, but just really make sure the things that you want to get across are, you don't want to do introductions on both ends. You want time to tell, as a founder, your personal background and the why, right? The genesis story of the business, and why me, why us, why this moment, what we do, and get a little bit of the exciting traction across. So that's the heart of what you want to do. Another really important thing that you want to do in that meeting is be able to ask a few key questions of the investor that you're meeting. And if they haven't covered this in their own brief intro, sometimes they don't, make sure that you ask. But you want to know, especially in this market, are they actively deploying capital right now? Is a really important question. What's their check size? What does your process look like? And that's really important too. And so you come out from the meeting really knowing, okay, this is something to really prioritize because they're actively investing, or maybe this fund is actually raising their next fund right now and they're taking get to know you meetings. You can kind of prioritize that accordingly. So really encourage you to make sure you get that information out, and then try to land your next meeting in that meeting right at the end of, great, well, now that I've talked through your process, I would love to send you the data room. And if it sounded like they were really digging in on product, let's say, and could we set up a time next week to go through a brief product demo and answer any other questions that you have? That might not happen in real time. You might land that, you might not, but I would say try, right? And so try to really use that time to the max and make sure that you ask questions the two-way street. So step 4, after you've had the meeting, my favorite thing when we raise funds as well is to send a quick thank you and follow-up that evening. So I always send my follow-ups the same night that I had the meeting. It could be the next morning, but it shouldn't be more than, definitely within the first 24 hours. And even if you said, let's say you had a great meeting and the investor asked for cohort analysis data coming out of that meeting and you don't have it, and you told them, like, I need to pull that together. I'll pull that together for you. And like it's going to take me a week to do that. Still follow up that night with a thank you email that you appreciated the meeting. Here's the action items, and I'll get that to you within the week, right? Rather than waiting a week to follow up. You would be surprised at how shockingly rare follow-up for meetings is. And so again, just in terms of differentiation and setting yourself apart in that top echelon. So here's a few things that that delight investors when you do them. Okay, so a little bit more of the softer side, sort of what makes a first pitch a success. And different founders and different investors, have different preferences for sure. But some of the core things, we just talked about a little bit of this, is definitely you have only 30 minutes. Please remember to really zoom out first, right? Communicate the big picture vision of why this is going to change the world. And this is the big sort of macro view on, to reference my earlier example, the ultimate potential impact on women's health and maternal health. Right? And then we get into what are we specifically doing? And then we're going to get into really nitty-gritty traction and numbers. But sometimes it's a missed opportunity to zoom out first and then articulate the why, right? These are short meetings. The goal, the first pitch is to really inspire, to hook, and ultimately to set up the next meeting. So think about that, but then dig in. And I would say there are a few times when you don't have every metric available, but if you can try to know as a founder, especially at the early stage, to know the numbers inside and out, right, around average contract value, around churn rate and retention, around utilization and engagement data, around net promoter score, or other indicators of that users love your product. You know these numbers inside and out. It sets you apart as well. And there's the occasional number that you might not have off the top of your head. That's okay. Just say I'll get back to you on that. But really, that knowing that data in as real time as possible has correlated with success for founders that we've worked with. And we talked a little bit about those already. In terms of the don'ts of what not to do, so definitely don't make assumptions, right? Like, oh, they took the meeting with me, so they must be investing. And this is frustrating to me as an investor when I hear that, funds have been taking so many meetings with companies without disclosing that they're not actively investing right now. So don't assume anything, right? Feel free to just get your questions jotted down ahead of time and make sure you get them through. Yeah, I wouldn't in the first meeting just pitch valuation right away. The exception to that is if you have a term sheet, right, or you have the round terms actually finalized. That's great to share that. But in general, the goal again is to talk about your company, what you're raising, what you'll do with it, and then that valuation conversation can happen a bit down the road. Be cautious of happy ears. Right? I think that everybody by nature is going to default admire what you're building. And that doesn't necessarily mean that there's a likelihood to invest per se. So really trying to filter, what is your process? Do you typically invest in this? If it's outside of what they typically invest in, for example, in a firm that does purely B2B investing and you're a direct to consumer company, definitely ask that of, okay, I noticed that primarily you're B2B. Would you look at a direct to consumer investment? And then lastly, don't be defensive, right? We know this is your pride and joy. This is your life's work, and you should be very proud of it. And sometimes questions that are probing, it is a superpower to just be transparent and not defensive when things might not land the right way. Okay, so when things are moving towards a seed stage round, and these are things that really come into play in priced rounds. If you get a term sheet, for example, and at Bread and Butter, we like to use the standard National Venture Capital Association, or NVCA standard terms for our docs and our term sheets. And you can find those available online if you're doing research or you're thinking about raising capital. But I'll tell you that when you look at a term sheet, what are the most important things to look through? And here's a quick list, and we'll go through them. So of course, you care about round size and valuation, right? And you care about what type of round is it? Is it a priced equity round? Is it a safe note? Is it a convertible debt note? Make sure that you pay attention to the pre-money versus post-money valuation, and especially if it's a safe. Sometimes that's been a point of confusion in the past. But valuation, that just refers right to if it's a $12 million post-money valuation, that means at the end of this round, after we've taken in this capital, the company will be valued at $12 million. So those are the table stakes, of course, but other things that might not be super obvious. So option pool tends to get negotiated at the seed stage, which is the amount of equity that is carved out to grant to employees as they are hired. And so at the seed stage, we love to see our standard is a 10% option pool right after the seed round to allow the company to have enough shares to make key hires and to issue options to them prior to their next Series A raise, the big Series A raise, and also to top up existing employees. So that will come up, right? Where's the option pool? Sometimes we see it a little bit higher than 10%, sometimes a touch lower than 10, but typically about 10%. Thirdly, you want to think about a board. So seed stage companies, typically we see the seed stage, if it's a larger round, let's say it's a $3 million seed round, that is where a board comes into play. And you might already have a board that's, you and your co-founder, but this is the first board with representatives representing the preferred investors. And so our preference at seed stage is to see a board of 3 people, so 3 directors, where If we lead around, for example, we would partner and take the board seat. So that's the preferred board seat representing all of the investors who own preferred equity. And then the other two seats would be representing commons, representing the company shares. Always the CEO, maybe it's another one of the founders. If it's a solo founder, maybe it's, a trusted advisor, an industry expert, but typically a 3-person board. So that's really important to pay attention to. What's the request at the board stage? At seed stage, the founders, the common stock should still control the board. Liquidation preference is a really important one. What does that mean? That means that upon liquidation, right, upon exit, that's typically, let's take an M&A scenario where you get acquired for cash, right? Liquidation preference refers to who gets paid out what on the stack. And so the stack typically is investors get preferred shares, right? That sits at the top of the stack. And then employees have common. And so typically, let's say you are selling a company for $100 million. The investors are first gonna get paid back before the common does, and then the common will. But pay attention if there are any unusual terms around liquidation preference. The NVCA, again, standard is a 1x liquidation preference, which means if I've invested $2 million, I'm getting $2 million back, paid back, right? Sometimes you'll see terms that are like a 2x liquidation preference, or in a really tough market, we've seen crazy things like a 3x liquidation preference, which is crazy. That means if I've invested $2 million when you sell, I will be getting $6 million back if I had a 3x liquidation preference, right? Before anyone else gets their return. And so as a founder, be very cognizant of if there's something that's not a 1x, there needs to be an extenuating circumstance around why that is in that moment. So take a look at that. Founder vesting is a really important one. And this is important whether or not you're raising a price seed round, frankly. So it's really important day one of starting a company, or as close to it as possible. We highly recommend that founders put themselves on a 4-year vesting schedule, right? That's the standard 4-year vest, which is a 1-year cliff. At the 1-year point, 25% of your equity vests. And then from there, it vests monthly for the next 3 years. This is super, super important. And we have seen a lot of things change at the early stage, right? It's fluid, right? We see a lot of teams that start out with multiple co-founders, and that situation changes. Life happens. Sometimes it doesn't work out for a variety of reasons. And it is really hard for a company to have dead equity on the cap table. We call it dead equity, is when, let's say we had 3 founders, Anna, Steph, and I started a company together. We own a third, a third, a third. And for some reason, one of us has to leave 6 months in and walks away with a third of the equity. That's tough, right? We're not going to be able to, we need that, the capital, we need that equity to be able to hire people. So just pay attention to that and know that at the seed stage, your investors might require founders to reset vesting, or if you don't have vesting at all, to implement vesting. And then voting rights is really important to look through, right? Of who on your cap table has the ability to vote on key things like the approval of an M&A transaction, the approval of new shares being issued. So these are some of the more important terms. And then I would also flag preemptive rights and information rights is another one, which is the ability to have the right to invest someone's pro rata in the next round. A lot of investors will ask for these things, and just keep a list of what you're committing to so that there's enough room at your next round. You're going to want your investors who've stuck with you, hopefully, to be in the next round, but just make sure that, if you're giving pro rata rights to everybody, how will that impact your next round? Just really quickly, I'm not going to walk through each of these, but just visually to show you kind of the layout of a seed stage deck. We recommend no more than 12 slides, so plus or minus 12 slides. Feel free to have more supporting documents in the appendix, but keep it nice and short and sweet. And so here are some of the things that we love to see. This is very, very familiar to you. Every investor will say something different, but where I spend the most time on an investment decision at seed stage is team. Where I spend the most time in an investment deck is traction. And so traction and business model, and just trying to understand, less so that you have unbelievable traction today because it's early, but really, what do you consider traction, and how are you thinking about the key performance indicators or KPIs of success for this particular business? And vision. always open and close with a big picture vision. It's just, bookend it. Okay, best practices post raise. Okay, so we're gonna zoom through the part where you just closed a really successful seed round. The journey begins that day, right? It doesn't end that day. And so just a couple quick things to cover here. Number one, most important thing that I could share, which is a theme of this presentation, is that exceptional communication will continue to set you apart. And if we look at companies in our 75 company portfolio, the ones who are the best, most consistent communicators, it correlates with the best business performance too. So when we invest, we ask companies to send once a month a written monthly update to investors, to us, but also all of their investors, that's tracking the same metrics each month and is tracking highlights, lowlights, asks for help. We know that the companies who tend to fall off communication is a red flag for us, that something has gone astray. We hope to be your first call when things aren't going well, so we can problem solve and work together. That's my number one best practice piece of advice. And then two, with your lead investor, we recommend a monthly one-on-one. We do half-hour one-on-ones with our CEOs after we've invested, to really help so that your investor can be an actual partner in the journey. Okay, quick note on closing process. So you've got terms have been set, docs are done. You're going to really try to communicate. Your job is to quarterback and really project manage the entire closing process. So sending docs out, collecting signatures, wiring funds, communicating. And we can go through this in more detail. But really just thinking about your job is to really shepherd that process through the close. Okay, I want to start shifting over to take some questions, but I will say that we'll circulate the presentation that I just did, and everybody who's joined us will have access to sign up if you'd like for office hours. Office hours are totally free, just a one-on-one 20-minute quick session with someone from our team. So you've met Steph's our incredible head of platform. She is an entrepreneur by background, amazing operator, also has a background in journalism, media, marketing. So a lot of ground that Steph could cover with you. Brett is our other general partner, 3-time founder, brings an incredible operating perspective. Brett leads our food tech investing. I lead our healthcare investing, and then we both team up on our enterprise SaaS vertical. So I will say that with the caveat, whether or not we're a fit for investment, if you would like to get advice outside of that or just general advice, we'd be glad to chat with you, and we'll circulate those specific office hours links to sign up as a wrap up to today's session. I also included some thoughts on lessons in leadership, which I'm not going to go through now in the interest of time, but I'm going to leave those in what we send out afterwards as well. So with that, let me pause, and I would love to take some questions.
Yeah, we've got one up in the chat. If we know that the initial seed capital for first 24 months, do you want to unshare your screen maybe? For the first 24 months needed is $5 million, but want the raise to be 50% VC and 50% high net worth individuals and network. That could be early clients. Do you believe that model is something typically palpable to VCs, like raising half from angels and half from VC?
Sure. I mean, absolutely. I think my question would be why? Like, what's the composition of your cap table is really a question for you as a company. And so we're completely open to that. I think we think about, we have high net worth individuals, we have traditional VCs, and then you might have strategic investors as well, depending on the type of company that you're building. And so any composition of that works. Just make sure that you are being incredibly thoughtful and thorough in that composition that you're pulling together. You also want to make sure that your lead is ideally writing a big enough check to kind of take a good chunk of the round, right? If you're raising $2 million, you'd probably rather not have 20 investors closing in that round, maybe have 5 or 6. So think about that. But from a VC's perspective, it is not a detractor at all to have amazing individuals on the cap table, especially at the early stage. And we see that in almost all of our companies.
And then the follow-up is, do you recommend finding a VC that will take on the lead for this? I guess you kind of
answered that.
Yeah, I think that when do you need a lead and when you don't, maybe is the way to think about that. If you're raising a smaller round on a safe, let's say $1.5 million on a safe, feel free to set your terms and go out there and see if you can get it done, right? When you need a lead, really, and so you don't sort of need need a lead to raise a safe, in my opinion, on the smaller side. If you're looking to raise $3 million round, $4 million, $5 million round, that's when a lead is great. If you're looking to raise a priced round, you'd like a lead for that. So there's a little bit of flexibility there, but sometimes I'll meet founders where they're awesome business, great traction, want to raise $1 million on a safe. I'm sort of like, great, put a cap on it and go raise, so think about the different scenarios there.
I've got a question from Andrea. You mentioned an overview deck. Is this different than the pitch deck?
Is an overview deck different than a pitch deck?
Or the deck you cover in your pitch meetings?
So sometimes we'll have two decks. One is much more detailed, but typically no. I think that for seed stage, the 12 slide deck plus or minus is the deck. And then feel free to have a lot of other supporting documentation that you bring up as a follow-up as necessary, right? So if I'm building a healthcare company that is payer reimbursed and I have a snapshot of my traction, I might have like a 3-page addendum that really goes through the contracts and the models on that. That's a different thing that doesn't belong in the main deck and probably doesn't belong in the first conversation. So I think one main deck is great. And then think about the different follow-up collateral.
Awesome. And a question from Jolly. What percentage of the round should lead investors want?
It's a good question. So there are some firms who take the view that they want the entire round, and there's a few of those. That can work. We don't do that at Bread and Butter for a few reasons. One, it's not kind of our economic model of our fund. So we're not writing $3 million checks, right? We're writing up to $1 million first checks. But the second reason, which I think is more important from my perspective, is we like to see multiple investors around the table. And it is 100% proven when times are tough, when you need a bridge, even when times are great and you need different types of support, to have that core group. All of my favorite experiences have involved teaming up with other firms in the trenches to build a company. So I do think that's nice. If you can have a lead investor that takes, half the round, somewhere between a third to 75% of the round, but you'd like to leave room for a few other folks is my personal view.
A question from Yasmin. How important is the in-person pitch versus a Zoom pitch? Should you plan to meet in person second or third meeting?
Yeah, that's a great question. I think things have changed since 2020 for sure, right? And we're seeing a lot of firms, ours included, who are making a lot of investment decisions virtually, and that can be done absolutely. So don't let that be a barrier. If there's an opportunity to meet in person, it is always preferred. I think it always just comes across in a totally different light. So when we're getting really serious with people, yes, like when I'm pitching LPs for Bread and Butter, for example, if it's starting to heat up, I will myself try to foist myself upon them by saying like, hey, would love to come to Cincinnati and meet with you. Could I take you to lunch? And so feel free to be proactive in that, right? Or if you're going to be traveling for a conference, we just had a round closed 2 weeks ago, and the other firm, we led that round, but the other firm who came in a very meaningful way, the founder happened to be at a conference in the Bay Area, and she was there for a conference too. And they were texting. He's like, when do you have time? She's like, I'm free right now, but I don't know where you are. He's like, I'm in the Uber. Right. And so if you can align industry events, but not a requirement, but a nice to have for sure.
Yeah. Another follow-up from Nicole. How do we determine which company could be the lead investor? Or how do we determine which company could be lead investor if there are multiple term sheets?
Yes. If you're in a great position to have multiple term sheets, congratulations. And I think there's a lot of ways to think about that. Ultimately, think about the partner that you want alongside you for the next 10 years. And maybe the journey ends sooner than that. Maybe you exit before that. Maybe things take a different turn, but think about it in that long-term view of who do I want? It is so much more than capital. And so really do your diligence. One of the most important things when you get a term sheet for getting close is VCs will ask to do references on you as founders. Absolutely 100% ask to do references on them. Do your own back channel research already with your network, but specifically ask them. And I love, it shows to me, and that's not very common either, right? When a founder asks to do references with portfolio companies, I think that's such a wonderful signal that we're going to have a great two-way partnership. So, but I would base it truly based on who is the most aligned with you, how do they treat portfolio companies after they invest. The other thing to think about though is also size of their fund and their ability to put additional capital in, and just understand it's not a deal breaker if it's a small fund who can't put a second or third check, but just you would know that going into your next raise. So thinking through some of those factors.
Okay, considering the market and longer timelines, do you recommend coordinating a bridge and priced round at the same time?
I think you generally, from a focus perspective, I like to focus on one thing at a time when it comes to fundraising, while you're of course planning the longer term plan, but as far as pure execution of you are still running the business at the end of the day. If you know it's going to take a bridge, focus on the bridge, but have the very clear narrative of the outcome of a bridge to what, right? A bridge to what, and why is this enough to get there? We have that question all the time. We invest in seed extension rounds, for example, and we'll look and say, well, if the company's only raising a 500K bridge, but they're, very far away from 2 million in ARR, which is their Series A milestone, let's say, probably not going to work out, right? So just thinking about that very clear jump from A to B, but I would focus execution wise on one thing at a time.
If we have investors that don't lead, express interest, but want us to get a lead, how do we get a lead? And what are your thoughts about consultants that take a fee to match us with investors?
I don't love consultants at this stage. I think the time for a third party banker, for example, right, is when we're going to sell the company at very late stage, or we need a banker to run an IPO process. At this stage, it generally is founder-led sales for fundraising as well as for sales. And so I think that using your current network, founder networks that you're a part of, and getting those intros is absolutely the way to go. If you have people who are committing, who are not able to, they don't lead rounds, that's a great signal. That's great momentum. So I would say collect those, try to get a sense for their check size. Of course, their commitments are going to be contingent on where the valuation ultimately lands, right? But get that. And then as you get closer, ask them for permission, right? Could I share the bread and butter is committed to this round or wants to invest once we get a lead? And then when you get serious with lead meetings, you can say, I have 4 firms who are interested. Here they are. It's not vaporware, right? Where I'm trying to drive FOMO. Use that to your advantage of, okay, I already have 2 million committed of a $3 million round. I need a lead. Then really focus on when you're building your pipeline that we talked about earlier from day one, make sure that pipeline, your first wave should be to firms who can lead. Focus on that, right? And then don't wait too long before going out for the second wave of those firms who don't lead, but think about that and really try to leverage those early commitments for momentum.
Want to do one more?
Yeah, maybe do one final
Okay,
one.
last question. What are best practices to coordinate amongst investors in various stages of diligence?
Yeah, good question. So we've a couple things that have been successful. As you're getting farther along, you might offer, if you have current investors, let's say you've raised a pre-seed round, or you have a lead that's committed, you could offer to have one of those folks talk with a firm who's in diligence, right? So would you like to talk to my existing investor? They've offered to do a reference with you. That's really good. Sometimes investors will share diligence, and that's really dependent on the firm. So if you're the lead investor, you might be willing to share notes from sales calls. We're very sensitive to not bombarding customers, especially at the early stage, with 5 reference calls, or they're going to be like, what the heck? I just signed a deal with you 9 months ago. So thinking about, use that carefully, right? So you're going to save that for leads. And then ask if they'll share diligence, or maybe hit up a different customer. So thinking about that sharing of that. But you can also take control of things in your own hands, right? Steph and I are working right now on a Series A fundraise with the company, where companies are more and more starting to proactively draft investment memos, right? We saw like a beautiful Notion page version of one that starts to answer all the questions that a fund might need internally for their own diligence. And then they'll of course do their own pass, but sometimes I'm meeting with a company right now that I'm looking at, and she sent me at the end of the week, like, oh, hey, here's a memo with some additional research. And yes, we're going to do our own homework, but I thought that was really thoughtful, proactive, and had a lot of the great questions proactively answered in there. So those are a couple thoughts. Yeah, it's 1 o'clock, so we're going to wrap here, but we just thank you so much for your time. We really appreciate this opportunity. We will circulate the deck that I shared, and we'll circulate links to office hours. And yeah, thank you for being a part of this series. It's still a tough environment out there, but in many ways, constraint breeds creativity, and it's never been a more important time to be building. And please keep at it, and know that we'd be glad to support your journey as we can in the future. Thank you so much.